Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cent segment. I'm Pete Wargent and I'm here with Chris Bates. Chris, how are you?
Pete, life's good here. How are you doing?
I'm really good, thanks. Always look forward to our weekly 2 cents catch up where we talk through the big 3 property news stories of the week. What have you been up to through the week?
Oh, it's been a busy morning so far. It's my youngest one, Tommy. He's just turned 2 today. So, we didn't get time last night to make all the toys, which was a bad mistake because they wanted to play with the tool set straight away and the little train set. So I spent the morning making things. So I won't do that again. I'll make it the night before. So dad fail here. What about yourself? What you been up to?
Mate, you've got the terrible 2s to come, but I'm sure it will all be fine.
A 2 and a 3-year-old right now. So that sounds pretty impressive when you got a 3 and a 2-year-old. And for the next 4 months, I can say that. So
yeah, we're in birthday season as well, actually. But both our kids had their birthdays just recently, and so did I. So we've been eating lots of sugar and cake and stuff. But it's been pretty busy. I guess a lot of people are just in a bit of a rush to try and get something either bought or sold before year end. And a lot of people are actually starting to think about next year because it's been a very tumultuous couple of years, really. So a lot of people are just making plans for what to do over the year ahead. So it's keeping me out of trouble. And I was on the Australian Money Puzzle podcast, if I can say the words, this week as well, which got some interesting feedback. Don't read the comments, as they say. Plenty of feedback there. So that was good. What else is happening?
Look, it's very similar here. I think there's a real rush to buy. We've had a equal number of days. We've got like 15 purchases this month. I think it's the 15th today. So we're equal purchases per days in the month. That's a little bit higher than normal, to be honest, whether that's because the business has grown or whether we can just see there's a real urgency for buyers coming into Christmas. I agree. We're starting to see people think about 2024 now, and whether they should transact now, whether they should hold out to Feb, and there's a real sort of worry because probably only got another week. I mean, even listing your property next week's pretty dicey, right? 20th sort of November, you run a 4-week campaign. You're at Christmas, right? And if that campaign doesn't go to plan, then that property is going to sit on the market for another 4 to 6 weeks at least. And so you'd have to be game listing your property. You might see there's a bit of stock around off market or, pre-market coming on the market next year that they're willing to get people through. But I don't know if I'd be putting my property on Domain or real estate now unless it was super likely to sell, as it's a great asset. And so anyway, let's crack on the 3 stories this week, Pete. What's on the cards?
Okay, well, first news story. Real incomes have been falling in Australia, largely due to inflation, of course. So that's something we'll take a look at. In fact, there was some analysis that suggested of all the developed economies around the world, Australia's got the biggest drop in real income. So we'll have a little deep dive into that. Secondly, Fin Review piece, the rise of land lease estates, which a lot of people aren't that familiar with, but there's a fair few of them around the country now. So we'll take a look at that. That was a Robert Harley piece in the AFR. And then thirdly, a friend of the show, Stuart Wemyss, was in the Australian over the past week or so, a proposal to break the rental gridlock. Stuart's got a bit of an accounting and financial planning background, so he knows his tax, and he's got a few suggestions there, which we'll take a look at. So the first story, Chris, macro business went quite hard on this one. Australian households suffer the world's biggest income collapse. So interesting point. I mean, I guess in reality, what happened is that Australia's incomes went up, but then after accounting for inflation, which has really taken off in 2022 and also this year, I guess in real terms, we've basically seen incomes go backwards about 5%, which has taken us back to where we were in 2019. So I guess if you're looking at in nominal terms, i.e. the amount that people are actually earning from wages and other income, it's been up and up and up as it usually is. But after you account for inflation, which in Australia peaked at a high level, over 7%, we've actually gone backwards over the past couple of years. So it's pretty interesting. We got the sugar hit, but now the inflation's taken away with the other hand. So did you have a look at that one?
Look, I mean, I have a read of this, and I think there's two ways you can look at it, right? So if you are in the camp that hasn't had a wage increase or income increase, and, you know, where you work and what you do, you know, there just hasn't been that opportunity for you, and a lot of jobs just don't have that benefit, right? And if you've then not had an increase in your salary or much at all, or a drop because your hours are being cut or something like that, and then you've been hit with all these increases in your costs with the electricity and food and travel and fuel, etc. Ultimately, you're going to be doing it really tough right now. And I think that's when you look at the sort of the averages, right? I think there is a subset of the market that, you know, is probably getting wage increases that are above the real inflation, right? I would say this isn't a bad thing, right? And I obviously, if you're in that camp one, obviously it is bad for you. But if you think about it at a macro level, if we were still seeing major wage increases with major inflation, that's going to create a wage price spiral, right? And we're going to get even more inflation because we're going to have to put our prices up to cover the increases in inflation, in wages, right? And so I think this is actually not a bad thing to show that wage price inflation isn't going to get baked in, and we're going to keep increasing rates, because it looks like on this that our salaries aren't keeping up with inflation. And so if inflation does end up coming back down, then, you know, we're more likely that, you know, rates are going to get cut and our mortgage costs are going to get cut as well. So that would be my take on it. I don't think it's a bad thing to see in this scenario, because if our inflation was 6-7%, but we were still seeing real wages go up, that means our salaries are going up a lot more, and then we're going to get all this wage price inflation coming. What do you think, Pete?
I agree, yeah. So rental incomes have obviously gone up. Interest income's gone up. So the wages is the big one. And since 2020, so since June 2020, the wage price index shows real wages, i.e. after inflation, going back 7.5%, which is an extraordinary drop. I think the thing when you look at the wage price index, though, it always seems to go up very slow and it lags a lot. I mean, in reality, we've had the tightest labour force settings, which we've seen in decades. And for a lot of people, that would have meant pay rises or changing jobs or, you know, moving to another location to earn a whole lot more. So it's not that every single person in the economy is only seeing wages going up at 3%. In a lot of cases, people have seen big pay rises, but it's not always reflected in the wage price index. Now, on the day that we're recording, the September quarter wage price index figures are actually out. So they'll probably show a big jump, actually, for the September quarter, about 1.5% just for the 3 months, because all those there was an outsized minimum wage increase this year, which won't flow through to the September quarter. All the awards increases as well come through this quarter. And of course, inflation will eventually start coming back down again, which will actually help the real wages on that sort of that graph that's been analysed. In fact, on the day we're recording, US inflation in October was zero. There was no inflation over the month, and it's down to about 3 or 3.2% over the year. And actually looking ahead, rents will fall in the US too. And rents have been a huge chunk of inflation over recent times. So US inflation is almost back down to the target now, and it will be fairly soon. And we'll be talking about interest rate cuts over there fairly soon. I think one of the interesting takeaways as well over the past 2 or 3 years, Chris, is that we talk a lot about the wage price spiral, but actually it does seem in a lot of cases it's kind of the other way around. It's prices that go up first, and then wages follow as people get minimum wage increases to match the prices. So I think some of these traditional economic models have been shown to be a little bit lacking. And I suppose the other big lesson from COVID is that fiscal stimulus can be a lot more effective at stimulating demand than an interest rate cut here or there. Because if you give people money, they'll spend it. So, yeah, I think the figures look really bad at the moment, but actually I think we'll see in 2023 where the wage price index will be up about 4%, probably see something similar next year. Inflation will come back down. So, yeah, it won't look quite so bad. And I think part of the 5% drop in real incomes is actually because incomes went up a lot and then inflation took back again.
Yeah, and what's your sort of take? I mean, 2024, there's some tax cuts, legislated. What's your take on how that's going to affect things?
Yes, I mean, the tax take in Australia has gone up an awful lot, actually, and the budget is now tracking in surplus, which seems quite extraordinary when you think back a few years ago. Just endless deficits as far as the eye could see. We've had a lot of income increase, though, from resources. The unemployment rate has been a big change. Very few people unemployed compared to recent history. And, if the tax cuts do flow through, that's going to help. Yeah, so I think there's definitely a disconnect here between nominal incomes, which have just kept on rising and rising, and real incomes, which is adjusting for the inflation in other parts of the economy. So, I mean, I guess my main question to you, Chris, was how does this impact the housing market? Because obviously record high incomes in nominal terms increases people's ability to pay. But if prices are going up as well, in terms of expenses, I mean, how does that impact the borrowing capacity?
I think the thing to remember is that the property market's priced on the marginal buyer, right? So it's based on how many properties are there for sale, and we know there's very low listings. It's everyone's stuck in their homes. The turnover rates, been reducing year on year for a long time, right? People are not transacting anywhere near as much and upgrading their homes every 5 to 7 years. They're doing it probably every 14 years, right? So, so less and less properties are trading, right? So that's the supply. And then what matters is who's the buyers in the market right now. What's their situation? And are they getting wage increases? And I think what's happening right now is there's enough people in the market right now, particularly on the middle to higher income brackets, that, they're having, because when you go out into the markets, when you're confident around your financial future and things like that. So the property market's still priced okay right now because you've got very little supply and you've got enough demand offsetting that supply, and they're people who are doing quite well financially and things like that. In terms of how it affects the borrowing capacity and things like that, well, the people who are doing borrowing capacities right now, who are buyers, are probably doing okay because their salaries have gone up, and then that's pushed, they can borrow more money because they've got higher incomes. There are some increases to minimum living expenses, which have been quite drastic over the last 12 months with the inflation. So, but ultimately, borrowing capacity is just ridiculously tight right now, not because incomes haven't gone up or expenses have gone up, just because of the way that the mortgage has gone up from 2% to 6%, and then APRA have got a 3% buffer on that. So everyone taking out a mortgage right now needs to make, in the bank's eyes, be able to afford a mortgage at 9%, even though rates have gone up 4.25% now from 0.1%. So that's the thing that's really constraining borrowing capacity. So you're lucky to get a 4.5 times your income right now, which, back in the height of the boom in 21, it was probably 7 to 7.5 times. So huge reduction in borrowing capacity. But they're sort of, I would say, though, that the people in the market right now are probably not what this average suggests. And this doesn't include the debt in the mortgage market, and whether that's still, people can still afford it. And I think this is where this story really lands, is people with mortgages, if their salaries aren't going up, their expenses are going up, and their mortgage is going up, it doesn't take a rocket science to figure out that people are going to be struggling. We are seeing arrears rates go up, but they're on very, very low long-term averages. It's not something that banks are concerned about. The banks are being more and more vocal, particularly after their huge profits in the last week or so, that, hey, we're getting $7 billion profit, and if you're in trouble, give us a call because we'll help you. And I think that APRA is also supporting the banks to help. So anyone who is really struggling with their mortgage, obviously speak to your broker, obviously speak to your bank, and do not miss any repayments. That would be the last resort. Get a solution before you get to that position. And the banks will do things. They'll do payment holidays like they did in COVID. They'll go interest only. They'll do all sorts of things if you speak to them before you get into issues.
Yeah, perfect. So you may well get a discount on your mortgage if you phone up and you're nice to your lender, if you're somebody who's in that position. So definitely worth doing rather than going into arrears. So have that conversation. So thanks for that summary, Chris. Should we crack on with the second story? Land lease estates on the rise. So this was a piece by Robert Harley in the AFR. I think a lot of people aren't familiar with what land lease estates or land lease communities or what they are. They're much more common in the US. So in a land lease community, you basically own the home, but you lease the land where the home sits from the community operator, and you're paying a rent for the right to occupy the site with a manufactured home or sometimes even a movable dwelling in the US. This can be attractive for the investors and developers who make money from the annual site fees, and then ultimately, they can profit from the development or selling off those new homes after they're constructed. And I guess this is, it's a steadily growing sector in Australia, 12 billion sector according to the AFR. Across New South Wales, there's about 500 or so master planned land lease communities. So that houses 34,000 people across the state. Across the whole of Australia, it's 130,000. Now in the US, it's about 20 million people live on these land lease communities. So these, communities used to be quite popular for the over 55s or the retirees. I think, though, I personally don't like it as the owner. It reminds me a bit of back in the UK, where you get these sort of almost like caravans or holiday lodges and things like that, where you can buy into the community, but you're paying endless site fees. And then when you do come to sell, it's all on the terms and conditions of the operator, which are never going to be in your favour, obviously. And I guess these are the disadvantages that people need to think about before going into them. Because I guess traditionally you build wealth over time by owning a home, but it's not the same as the normal traditional home ownership. You could build some equity on the dwelling, but you don't own the land, right? So that's one issue. You're not going to build the equity. But the main thing is, apart from the expensive site fees, is it's just difficult to resell. When you come to sell, you've got to find somebody else to sell to, and it will be on somebody else's terms. That's assuming everything goes right with the estate. Obviously there can be issues in some cases. Very popular with the big operators, Stockland, Mirvac, and so on, who are making good money on this, but probably not so keen on that sort of thing myself, Chris.
Yeah, it's great for the person providing the land, but maybe not great for the person putting something on that land and paying a fee, right? The owner of the land still owns the land. Land's what goes up in value, right? And so they're making money on that land by basically leasing it out. It's kind of like a farmer putting cattle on, getting the neighbour's cattle on their farm. They don't mind that. They get a bit of money from, hey, leave your horses on my land, but I still own the land. And then they charge a service fee, and as long as those service fees can be quite hefty, when you add it up across all, so they can make some money on the service fee and, provide some basic facilities for that. But ultimately, I don't like the idea of building something on that, like a little studio that's not like a demountable or something like that, because ultimately you're right. When you try to sell that, like, you can't get bank finance on that. No one's going to give you finance. So you have to be a cash buyer. So then only cash buyers can look at it. The demountable is going to really age. Like, ultimately, everything gets older, right? And so it's hard to make money on that. The rules around selling it, and like Pete says, there's going to be a fee. There's probably a huge commission to sell it to somebody else. You're probably locked in. There's lots of issues. However, if you could get a shorter term lease of, say, a couple of years, and you could park a caravan on there, or, like a motorhome or something like that, and you just had to pay like saying at a caravan park, but that was your solution to being homeless, right? And then they had a shower facilities and you had a little community and things like that. I think it's a bit better, because if you don't like it, you can just put the keys in the car and leave, right? And I would say, and if you can take your asset away, but not have to pay, lose all this money on depreciation. So that's the only time I do think we're going to need creative solutions. But, if someone was in this situation where they could potentially borrow, a little bit more and get a house or an apartment or something like that, that would solve their long-term housing needs. But they've got an asset that they could potentially sell one day, and they're not just, paying for a demountable house on someone else's land that's going to be going up. I think these are big in areas where they're, not in the more affluent areas, right? They're, a lot of them are rural and regional and things like that. And I think it's a lot of people who haven't got enough money for retirement, and they sell their property in the city. This gives them a little bit of cash that they can afford somewhere to live, but then they can also have a little bit of money to live on. And I think that's the solution. But whether it's a solution for the mass market, I'd hope not.
Yeah, I think that's right, isn't it? I think at the lower end of the market, what people would do, if they didn't have a huge amount set aside for retirement, is that you could move into one of these estates. You'd probably get rent assistance to help with the site fees, and that frees up some capital for retirement. I think one of the challenges is that traditionally these were cheaper end of the market properties, but actually these days, the AFR piece highlighted there's some sort of premium resort style residences that are selling for $2 million or so, and they would include things like the bowling green and the gyms and the pools. But as you pointed out before, Chris, those things don't come cheap usually. And some people like it's like a clean and very often a kind of a safe type of environment for people, and sort of low maintenance from their perspective. But this stuff usually comes at a cost as well, which is obviously a site fee. So yeah, look, it's not for everyone, and just like everything else in Australia, the supply is not really keeping up with the demand for people who want to go down that route. So yeah, I'll just always say just caveat emptor with this kind of thing and really understand what you're getting into. The number of times I've heard people in the UK sort of buying onto holiday lodge type estates, and they enjoy it for a few years, but when they come to sell, they've got all kinds of problems because it's basically it's on somebody else's terms. They don't own the land, so they find that there's no sort of capital gain to speak of, and often it's a loss, and that's after you account for all the fees that sort of paid over the years. So yeah, definitely something to be a little bit wary of, and certainly understand what you're getting into before going down that route.
Yeah, and I think there's going to be some creative in this communities that are big blocks of land that people can't put houses on. We've seen clients in things like this up in Byron, to be honest. So it's a huge block of land, and everyone's got their little tiny homes on that land, and things like that might work. Like maybe there is these, but the mass market sort of product of the past, I think they're not great for the people, buying into them, because ultimately when they sell it one day, they're basically selling an older sort of demountable that's not worth what they paid at the start, and then there's issues selling it, and then there's all sorts of challenges with that. So what's story number 3, Pete?
Yeah, it's actually one of these estates down our way, just down at Buderim. And thinking about it, actually, over the past year or so, some of those estates, land lease estates in the Northern Rivers, got completely flooded out because obviously there was some massive flooding around Lismore and elsewhere. So yeah, definitely something to research very carefully before going down that route. So yeah, third story of the week. So I was on the Australians Money Puzzle podcast this week, and I was talking about the return of Chinese buyers, among other things. But yeah, the previous week on their property segment, Stuart Wemyss from Pro Solution, a good friend of the show, he was on, and he had a proposal, which was also reported in the Australian newspaper, a proposal to break the rental market gridlock. So just this week, PropTrack recorded record low rental vacancies in October, just 1% nationally. Further declines in Sydney, Melbourne and Brisbane, Adelaide and Perth, extremely tight. SQM Research also reported a drop in rental vacancies to just 1% nationally, so record lows, with rents up 15 to 16% over the year. Louis Christopher of SQM said, with high population growth and only 153 dwellings likely to be built next year, and that's before we account for demolitions, rents are just going to keep rising at a 10 to 15% pace. And he says basically immigration needs to be cut. So that was his take. Anyway, Stuart Wemyss's proposal for reform, which was discussed in the Australian, firstly, reducing the lending assessment buffer, which I think you and I both agree with, but also offering stronger capital gains tax discounts for encouraging investors to own property for longer. So, for example, if you own a rental property for 10 years, you might get a bigger discount on your capital gains tax. So what do you think about that as a proposal, Chris? Basically an incentive for people to hold property for a whole decade instead of 2 or 3 years and then flipping.
Oh, look, I love Stuart, and I think there's two elements.
Same thing as a no.
Yeah, I think the first thing is absolutely we can talk about lending. I think that's the key thing here. The the potential future tax advantages of holding investment. I guess you've got to put yourself in the investor's mind. The investor who's got an asset that's not performing very well, it's not going up in value, they're usually the ones who are selling, right? The person with a good asset that's growing, they usually do everything they can to hold it, and they hold it for 10 years because they can see the growth in it. And so then giving a bit of an extra tax advantage to them is probably not a good thing because they're going to hold it anyway. It's very, 20 or 50% reduction's pretty enticing. The person who's got an asset that's not performing and, it's not going up in value, and they've got tenant issues and, building issues, giving them a future CGT advantage for holding might be a bit meaningless when, they're not going to hold it anyway because it's not going up in value because it's an underperforming asset. And so I don't know. I think that's may not get the solution, because I think you find that in property investment circles is the people who have got good assets really hold them, and people who buy the poor assets buy them, and then a few years later they sell them because they realize they're not working for them. Look, I think it needs to be a complete shift in how lending works again for investors. I think this is a crisis zone, and I think we need to unwind a lot of what happened post-2015. And I think even anything, we need to make it pro-investment than pro-owner-occupier again. Because in the last few years, it's definitely been better, especially under lower interest rates, to buy homes than investment properties. And back when I started in lending, you could borrow a lot more to buy investment properties than you could to buy homes. And so I think we need to flip it to that direction again. The first thing, that there shouldn't be a higher rate for investment over owner-occupiers. You can see that in arrears rate. It's actually lower risk because you've got a rental income for that mortgage. And so I think investment rates have to go down to owner-occupier rates. And who's to say they shouldn't be lower than owner-occupier rates? It could be a complete flip. APRA could step in and allow banks to lend investment rates lower than owner-occupier rates. That's the first thing. The second thing, I think they need to give more clarity around interest only. So in the past, you could roll over your 5-year interest only really easily without servicing. And you could actually get 15 years interest only on home investment loans. St. George used to offer them. We've got a number of clients who still have those because they're so attractive to keep as investors. Because what that allows you to do as an investor is go, look, I know I can, as long as I can afford the interest for the next 15 years, and I've got rent, I just need to cover that shortfall for the next 15 years, and then I can worry about going principal and interest after that. By then, though, the rents will go up dramatically, my income will go up, and I can refinance it. So if we allow people to get 15-year interest only again on investment, and the reason why that's okay is because you don't need to pay off your investment properties. The reality is you've still got some equity there when you go in, or maybe you don't because you've leveraged off your home. But ultimately, that's not your home, so you don't need to pay that property off. You need to pay your home off? Yeah, okay, so maybe make sure your home's principal and interest, and maybe make the rules around that still quite restrictive to force people to pay off their homes. That's better for their, the banking system. But for investors, why are we forcing them to pay their properties off when they could just sell that property and pay off the debt? And so I would allow them to get long-term interest only. And for their servicing, I reckon we should reduce the buffer, because why do we need a 3% buffer on that when if the rates did go up 3% and they couldn't afford it, they could just sell it. It's not their home. And so I would say that you don't need to stress test them as much as you do for owner-occupiers, because owner-occupiers could go homeless, right? Whereas, and so I would say you don't need to stress them as much. I think they could have longer loan terms as well. I reckon, 35, 40-year loans. They would be my few. I reckon we actually at the moment, we discount rents by, used to be 20%, but now it's a 10% reduction to rents, just because, in case there's vacancy and costs. Well, maybe do we really need to do that? Maybe it should just be 100% of rental income could be included in servicing. So I think if you flip servicing from anti-investment to pro-investment, what's that, famous saying? If you change the incentive, you change the behavior. So if we change the behavior for the lending market to be pro-investment, not pro-owner-occupier, you will see more investors enter. You will see more investors being able to refinance and keep their properties. And we flip the tide to starting to create more investor demand. And that'll create more, people, and that'll hurt some people. It'll hurt first-home buyers. And so there's, not everyone can win in these scenarios. We are seeing a lot of investors exit the market. All the stats prove that, who are buying those property first-home buyers. So, yeah, we've got rental crisis, But are we seeing higher participation of first-home buyers? Yes, but it's probably not all first-home buyers. It's probably on the higher incomes rather than the middle and lower incomes. So that would be my take. Rather than changing some potential tax settings, I think it's a lending mindset shift. But no, there's always a compromise here. There's always a trade-off, and the trade-offs are the potential first-home buyers who want to enter the market.
Well, yes, it's a few different points there, Chris, and very well made. So Wemyss came up with a couple of other potential suggestions, more tweaks, I guess, allow people to sell an investment property and roll the capital gains into superannuation to encourage people to invest for their retirement. Also, potentially reinstating the 50% capital gains tax discount for Australian citizens who are non-tax residents working overseas, because currently you're taxed on the full 100% of gains if you're an expat, and therefore people are less keen to invest in rental property in Australia. I think, as Stuart acknowledges in the article, a lot of these are sort of tweaks and sort of band-aid solutions. And in reality, the rental crisis as it is, anything's going to take several years to yield results, and there's no overnight fixes, and things are likely to get worse before they get better. So to your other points on the 3 percentage points lending assessment buffer, I agree. It's too high. Like 12 further interest rate hikes from here. Come on, it's not going to happen anyway. And as you said, for an investment property, that could always be sold. I think in reality, APRA is going to hold that buffer until inflation is back down. I think they're trying to work in tandem with the RBA to sort of bring CPI back down, and fair enough, I guess. But yes, your point on interest-only lending, that's been shut out of the system largely for the past 5 years, and there's no reason that can't make a comeback. I think on the higher interest rates for investment loans, way back when the Bank of England did a paper which kind of suggested that in a deep recession, investors would sort of flood out of the market or have a rush for the exits, and therefore, because of that, homeowners would be more likely to stay put, but investors would sell, and therefore investor loans were somehow riskier. But actually, the experience of the past 20 years in Australia has not shown that to be the case. And in fact, arrears have generally been lower on investment mortgages because, as you say, most people, they've got the security of the rental income. And that's actually a point that Peter Tulip has made, ex-RBA person himself and economist of the CIS today, also a friend of the show. He's made the same point. There's no reason why interest rates should be higher for investors, and the buffers just make it too difficult. I think people are just saying, well, the risk-free rate's been near 5%. Why am I bothering with investment property when it's just too bloody hard to get a mortgage? So there's plenty that could be done there from the lending perspective, I think, and that would make a bigger difference sooner potentially than tweaking with capital gains tax. That's my take anyway.
Yeah, I think the expat point's really big. I think there's a lot of Aussies overseas that have plans to move back to Australia. They come to us as brokers. We do. First, we figure out all the, hey, you need to get some tax advice on this because the tax rules have changed a lot, and it might not may rule it out, which it does for a lot of people. Then you got, issues with actually getting finance. It's ridiculously hard for expats to get any meaningful finance, even though they're earning ridiculous money overseas. They could probably borrow it 2 times their salary. The way that the whole system has, reductions to their incomes for foreign exchange, not including bonuses, different calculators, a small number of banks. So I think, you need to get expat lending back. And I think changing the tax settings is go hand in hand, because if we could get Aussies moving back to Australia, buying in Australia, that's going to create some rental demand. And they also, at the end of the day, if they're going to move back to Australia, they're going to need to buy housing at some point anyway. So I would say and then also foreign investment money. I do think there needs to be a real world sort of attack, reducing the foreign stamp duties, particularly for new property. I'd basically say 0 stamp duty. And I would say if you want to buy new apartments in Australia, there's very little cost to buy them. There's very little stamp duty. And then that would pump up our sort of apartment market, particularly if it pushes prices back up. Yep, that might not be great investments for them, but ultimately, if that's going to solve our rental crisis in Australia and they want to put their money in Australia, a lot of the time for capital preservation, not capital growth, because of the fears of where their money could be held and if, the safeness of that. So I reckon that's what we should be doing. I think we should be encouraging a lot of foreign investment into Australia to support our construction industry and to create more, demand for high-rise apartments, to be honest. It's something we always sort of frowned upon a few years ago, but ultimately when we've got vacancy rates where they are, we've got a construction industry where it is, and we've got fast-growing migration, we need to do something. And if people from around the world want to build apartments in Australia and pay for them, then I think we should take the money, personally. What's your take, Pete?
It's a good point. Actually, under the radar, just over the past week or so, the ACT announced that they would be expanding the concession for people buying off the plan units or townhouse titled properties up to an $800,000. So, I mean, that's largely all of the market, really, for people buying units and maybe some townhouses as well. And that's going to be in place right through until 2026. So that's encouraging people in Australia in the ACT to buy off the plan. We might see some more of that in New South Wales and Victoria and Queensland maybe. And as you said, maybe trying to get some of the foreign buyers back into the new dwelling market. I guess the constraining factor at the moment is that we've got this enormous pipeline of infrastructure projects to be worked through. Got things like energy, transport, all kinds of public works underway, and that's taken a bit of the capacity away from the ability to build housing. But also costs. I was reading this week that the price of concrete is up 50% since the pre-pandemic level. So all of that stuff makes it hard to get housing built at an affordable price. But yeah, I think stimulating the demand for off-the-plan properties, well, it's happening in the ACT, and we'll probably see it elsewhere too. Yeah, it's hard to believe now, but at some point, maybe in 3 or 4 years' time, we'll probably see that supply overhang again. It does come round in a cycle. We get nothing and then everything arrives all at once. So, but yeah, in the short term, the rental crisis looks set to continue, I guess.
Yeah, and I think this is not for, Aussies living overseas that are moving back or, first-time buyers. Don't fall for these stamp duty concessions. But ultimately, if there was no stamp duty on, new apartments, right, and that allowed people around, and that was marketed around the world, and then basically we could make those projects profitable from a developer's point of view. They're the only ones they'd be pitching out there. Then I reckon you create a bit of foreign demand. I think if you went around the world and pitched that. And so, that would be my take on how to get some money, because, the locals aren't going to, fall for the stamp duty concessions, to be honest, and they can't borrow the money. Particularly first-home buyers and investors can't borrow the amount of money for the projects that do stack up. And so I think there's a real challenge there for the construction in the resi industry unless they can find some buyers. And I think we've got to, search across shores to find those buyers.
That makes sense. So just to wrap up on the 3 stories this week, real incomes in Australia have been falling, obviously due to inflation. But I think if you look at 2024, you'll probably find household incomes rise by about, let's say, 5%. And hopefully inflation gets down to a lower level than that. So things will be on the up and up again. The rise of land lease estates, that's a bit of a caveat emptor, I guess. If it's something you're thinking about, just be very careful about the terms and conditions before you go down that route, because they're probably not going to be in your favour. And then thirdly, a proposal to break the rental gridlock by Stuart Wemyss. I just saw the ABS this week had the arrivals and departures figures for the past 3 months. If you annualise the sort of net immigration figures, they're still running the last 3 months at a pace of about 500,000. It's the highest we've ever seen. So there's been no slowdown at all yet. I keep saying that immigration has to peak, and it still hasn't. So yes, for as long as that goes on, there's going to be no solution to the rental crisis, quite frankly. And at some point, immigration will have to slow. Capital gains tax proposals is just one of the things it could be looked at. And Chris has mentioned a whole raft of other potential solutions, making lending easier for investors, encouraging off-the-plan apartments again for foreign buyers, and probably some people in Australia too. So I think that's about it for this week, Chris. So if people want to get in contact with your questions, we've got links in the show notes of how you can get in contact with us, or send us your questions so we can cover whatever you want us to talk about or whatever's a hot topic. So Chris, what's on for the next week?
Head down, bum up. What's happening at work for us and our teams? So a few new hires and lots of some big plans in there, which I can't reveal yet, but they're coming out next year. So Lots happening in the run up to Christmas. I've got a few weeks in Thailand in January, so I'm excited for that. But yeah, you don't think about a holiday till you're on the flight. Isn't that right, Pete?
Especially because you've got the terrible twos to deal with, but I'm sure it'll be fine. Yeah, it's a bit of golf for me this week. So, yes, and hopefully Spurs can get back on track because we've been diabolical the last 2 weeks. So it is what it is. So thanks, everyone, for joining. Always enjoy our weekly 2 cents segment every Sunday at 7 a.m. and look forward to catching you next week.
Chat soon, Pete. Talk soon.